Allow me now to introduce and to bring up our first panel. Ladies and gentlemen, first of all, we've got obviously Patrick Sumner. I'd like to bring up Lesiba Maloba, the General Manager, the Property Investment Public Investment Corporation. Where are you? We'll put you in the middle here, sir. Andrew Brooking, the Finance Executive of Java Capital. Where are you, sir? Why don't you go over at the end, in that seat there? Estienne de Klerk, your President-elect, who is the Executive Director from Growthpoint, joins me. Sir, you can come here. And Anton de Goede, the Fund Manager from Coronation Fund Managers, is here as well. You're there. First... Oh, you can do better than that. Come on, please. That's it. Give us a hand with this table. We should move this table back into position again. Make a picture. It's not often you're going to see executives do this. And nothing got broken. Right. First question to you, Estienne. When you look at what we've just heard from Patrick, Estienne, put the global back into the local for us. You hear the returns that Patrick was talking about, and suddenly, frankly, South Africa, excellent.
Certainly, if you look over the past 14 years, South Africa has performed the global indexes by many multiples. We're talking, if you invested in the US, which is arguably one of the best performing markets, you put in a dollar, you would have maybe had $2.50 at best. And in the South African context, you would have had a rand going to over 1,000 rand, in that same time. That's now not taking currencies into account. One of the biggest driving factors in the South African market has been the yield compression, so the interest rates coming down effectively over the period. And the second thing that drives our market, which isn't existent in many of these international markets, is the fixed income growth. So we have contractual escalations in our leases.
We'll come to all of that in a moment. Lesiba, you're the one with most of the money, aren't you? I mean, come on, we're amongst friends here. So what do you like and what don't you like at the moment?
Well,
right,
I think
there we are.
As a PIC, we're participating both in the unlisted and in the listed space, okay? So it's always a little bit of a challenge when you're competing with the listed sector as an unlisted investor. So for instance, when it comes to acquiring good assets, and there's very few of them at the moment. Now, because of the trading yields for the listed sector and relative to the NAVs for unlisted, then we end up competing, and to be honest with you, from an unlisted point of view, you cannot compete with the listed sector. So that's really one of the aspects that perhaps for me, as the PIC, becomes a little bit of a challenge to grow my unlisted portfolio.
But you have a big challenge, don't you, in the sense that you've got so much money that, well, no, it can be a problem. Because when you move your money, you effectively become the market, don't you?
Yes. So
tell us how you negotiate that challenge.
Well, we sort of do things very quietly.
But you can't do it en masse, can you?
No, we can't do it en masse. So it's just a matter of taking time and being very discreet about it. And maybe sort of deflecting attention from what we're doing, making people focus on the other areas where there's growth rather than where we are moving money.
What has helped them is obviously the very strong returns in the listed property space. So it's kind of helped them to get the asset allocation they require in terms of nominal terms.
Andrew.
I think this yield compression that Estienne referred to it's been the rising tide that lifts all boats. So now if we're into a world where there's a greater prospect of the tide going out than coming in, we've got to look for themes that deliver growth or have particular pockets of value. And there are deep pockets of value.
Tell us more about this yield compression dilemma that you now face.
Well, the SAPI, the index for the sector as a whole, is sitting at 6%, compared to government, the 10-year government bond at 6.25. So it's hard to see that 6% coming down any further. So it's hard to see the general value of listed property stocks increasing. After all, on average, they're at about 150% premium to NAV. And some of the top end of it are at 190, 200% premium to NAV. So that's the challenge where we are. The sector's delivered and performed incredibly well by any metric. There's no massive correction or implosion, but the rocket fuel that is yield compression is probably out of it. I mean, I think everybody would say it's out of it.
You're nodding, Anton. If that is right, what takes its place?
Well, at the moment, we're looking at global property as an alternative to local property. Patrick referred to Europe, where you can still get yields, 6, 7, 8% yields selectively. And you look at the security of income stream you can get with that yield. It doesn't necessarily need to be a growing income stream, but you get security in that income stream.
So when you say you're looking outside, you're looking global rather than local. Bring it closer to home. Are you talking continental, as in within the African continent, or are you talking truly Europe, US, Australasia?
Unfortunately, in the listed space, ex-South Africa is still quite underdeveloped. So there's only a few listings within our neighbors immediately, let's say Namibia and Botswana, and 1 and 2 elsewhere in the continent. So we're looking at places like Australia, like Malaysia, like Japan, although Japan has run very hard, and Europe in itself.
Patrick, if they're right, if you're right, you've got their money coming towards you, which is probably what you need at the moment.
Yes, I do. We not
Just
only,
write the checks. Just send them on.
we're not alone, but we have seen some pretty strong inflows into the funds, the global funds for the diversification. And this, I think, is partly to do with anticipated performance of underlying property. We have a big yield gap in the States, certainly, and in Europe, and in a number of Asia-Pacific countries. This yield gap has never been this big. 4 to 4.5% yield gap, the difference between property yields and bond yields. And people are worrying not so much about your yield compression issue, but about what happens when bond yields start going up, what happens when interest rates start going up.
What does happen? And when?
Obviously, the question would be when and to what extent those yields are going to go, the bond yields move up. If they move up very quickly, then you're going to have capital pain in the global markets, not just real estate, equity as well. And I think, bringing it back to property, the one thing that Anton fails to mention is when you go to Europe and you go and invest in one of those counters, you're getting no underlying income growth. Most of those funds are going backwards, or it's literally like a bond. Whereas in South Africa, albeit that the prices are at record highs, we're offering a very attractive yield still, but generally our companies are growing in a range of, say, as low as 2 to as high I've seen as 12%. So I don't know how consistent some of those high ends are, but certainly that is a big selling feature.
Yeah. Just what I want to point out, on the positive side, is that you do have some of the stocks that are trading at extremely low yields relative to the bond. But then at the same time, you have good quality stocks that, portfolios that are still trading above those low yields. So there's still growth potential. And then you also have new funds that are coming into the market that are
But
quite
anybody looking at the listed sector and seeing the numbers, and seeing the growth, and seeing the potential, would be tempted to say, would they not, Andrew, that things are frothy, to say the least, and worryingly so at best?
But that's a simplification, because they would be tempted to say that, but it's not uniformly true. There are pockets of very deep value in the already listed space, and there are pockets of very deep value in property portfolios allied to developers that will come to market to take advantage of REIT-type dispensations. So it's not uniformly frothy. there is still, I looked at a piece of research that came in just now. There's keeping the tide constant, so no adjustment to the SAPI. There are components of the listed space that could deliver 36% total returns in a year hence, versus at the other end, some that could move by 3 or 4% negatively. So it's not uniform.
All right, if it's not uniform then, Estienne, what is the biggest single danger to the market in South Africa? I want to keep it within South Africa for the moment now. What is because that's really what these people want to know.
Yeah.
They want to know, A, how good is it got?
Yeah.
And 2, is it as good as it gets?
Yeah.
Yes or no?
There's 2 issues in my mind that are
Speak up.
collectively 2 issues. The first is, well, can't you hear me?
No.
Oh, sorry about that. The first issue is the growth within South Africa. So that drives actual demand for office, for retail, for industrial space. So that's the first thing. And then the second issue, which is tantamount in my mind, is administered costs. So what we have seen is double-digit administered costs coming through, and ultimately that will have a huge impact on the margins in our businesses.
With the size of your portfolio, Lesiba, those administered costs must be keeping you awake at night if they're those numbers.
Well, I think they keep everybody awake. But for us, in as much as we work with the rest of the industry to try to contain those costs, we also sort of focus more on the economic side of the business to say that if the economy is not strong, demand goes down, and at the end of the day, the listed sector is underpinned by properties, physical properties. So if
But what can you do as an industry on administered charges and costs? Because as I alluded to at the beginning, you are the cash cow waiting to be milked at every available opportunity. Isn't that right, Mayor?
I think maybe we're not, because for us, as big as we are, we honestly look at the quality of the investments and we look at the NAV, sort of participate the same as everyone else. Perhaps the perception may be different, but the quality of the assets is always very important to us. And I think that at the core of it all, that's really what we're talking about, is the assets.
I just want to get back to the risk that you say, what's the biggest risk to the industry at this stage? And to the listed industry, I would say it's more our bond yields are the biggest risk to the industry at this stage. We're seeing our government borrowing more and more and more from the bond market. We're seeing a lot of inflows from developed markets into emerging market bond markets. Our bond markets have reacted, and over the last 12, 18 months, most of the returns out of the sector hasn't come from the income portion. It's come from just the correlation with bond yields. So as soon as we see a threat of interest rate increases, inflation coming through, bond yields being hit, the property sector will be hit immensely.
Talk more about that.
If you go back, let's say, to the end of 2007, when there was a kind of a whiff of interest rate increase, the sector started moving faster than bond yields, and the fall was much quicker and much further than bond yields.
And that fall being driven by underlying economics or by straight interest rate differential?
Underlying economics flowing through into inflation, flowing through into bond yields.
Which, of course, South Africa already has such a high rate of inflation to start with. Patrick, there's no worry about that elsewhere, is there, at the moment? I mean, inflation's dead to all intents and purposes in your markets.
Not in the UK. I mean, we've still got quite stubbornly high inflation, although it's coming down. I'm not clever enough to know what inflation is going to be. There are lots of very clever people out there saying that the result of all this QE is inevitably high inflation down the road. I'm not sure that's true. But I think going back to the question about what happens when bond yields start going up, it depends why. If the politicians get the timing right and the phasing right, it could be because the economy is improving, at which point you see rents going up, so actually property yields can come down while bond yields are going up.
But there you've got to differentiate between South Africa and our natural escalation rate that's built into our rentals already versus globally, where economic growth will lead to higher rentals and where you get negative reversion, versus positive reversion in a high economic environment.
Yeah,
Okay,
that's the difference.
let's not get too deep into the depths and the weeds of bond yields, although we're welcome to if you wish. Because really, at the end of the day, what it comes down to, back to this idea of, Andrew, a feeling of whether there's something waiting to happen in the property market in South Africa. Do you believe there is something waiting to happen?
I don't think there's anything dramatic. I think the fundamentals are pretty good. There's some challenges and there's some opportunities.
Well, hang on. Let's not be general about this, too general about this. Let's take retail, for example. Every article I've read on retail talks about the unsustainability because of saturation and the levels at which it's reached in the continent, in the country. True or false?
False.
Just as well, he owns a lot of it. True or false?
Yeah, I don't think it's entirely true. I think that if you
Hang
go
on.
and look at the growth, and I'll explain. If you go and look at something that Paddy referred to with regards to the biggest shopping centres, they have continued to perform very well, and trading densities in those shopping centres continue to perform very well. It's in the very smaller shopping centres that you've seen difficulty. So there's change in spending patterns, and even in the current environment, we are seeing the retailers growing earnings at above inflation.
Just to add to that, when I said false, it's because if you look at the performance of your super regionals and even your community centers in terms of occupancy rates and vacancy rates, I mean, your super regionals are sitting around 1.8%, vacancy rates. So that in itself, if we were to be in an efficient market, would say you can build another shopping center. I'm just saying from a theoretical point of view. So, and if you look at outlying towns in the country, there's still huge demand for retail. So from a saturation point of view,
So why am I reading stories about saturation?
Perhaps
It's some nodes. It's
Sorry?
not all nodes.
Yes.
It's not all the nodes. It's
Yes.
some nodes are very saturated. It doesn't mean the country as a whole is saturated. So I think saturation is a theme for only some of the retail nodes, but not all of them.
You're smiling, Patrick.
No, not really. I mean, I don't know the statistics, but you do see an awful lot of quite small shopping centres. What about the demographics? Are the demographics actually driving? I can't actually hear what any of you guys are saying, but I think you were saying that demand is increasing as the black middle class grows and there's more disposable income. Is that a theme?
The theme is that historically you had undersupply of retail space. Okay. So for instance, when we talk about saturation, I'm trying to figure out, except for specific nodes, what we know is that a lot of the markets are still undersupplied. And so there's still quite huge room for more retail space in the market.
I want to just turn to the REIT, because you said that it was the arrival of the REIT or the prospect of the REIT that drove prices in other places, correct?
No, I suggested that there was a possible cause, but I didn't know the real reason.
Are you a possible cause?
Only a possible cause.
Can we live with possible cause?
Yes.
Right, we'll live with possible cause. Possible cause in this country of the arrival of the REIT.
That REITs are driving. I think certainly a part of the recent run in the listed sector has potentially been the arrival of REITs, and it is driven by some of the international investors coming into our market. So I would suggest that our local asset managers have been net sellers rather than net buyers in certain cases, to the extent that they've got new mandates. They have been buying, but I think it's more international.
You and I were talking last night. Anybody looking at the REIT and looking at the advantages of the REIT might be tempted to say, what is it about the property sector that makes you so advantageous and lovable that clearly you have to enjoy this benefit?
It's a great place to channel the nation's savings. And that's why
That's him, isn't it?
That's why we get this tax dispensation.
That's our friend here, isn't it? It's a great place for him to put his money. So you're basically saying that the REIT is that's one of the fundamental reasons why you have been granted such extraordinarily favourable taxation status.
It's a reason. Another reason is that it's done all over the world, and we want to be comparable. So we want to put the smaller investor into the same position as if the smaller investor bought a slice of the property directly. And that's all we're doing.
Yeah, I mean, it actually mitigates the danger that exists when people want to invest in real estate and buy unlisted funds.
Right.
You know, we've seen in Germany the open-ended fund issue. We've seen in other parts of the world. People get stuck in unlisted funds when they want to get out, and it's, this solves the problem.
We need to take some questions. Can we have the house lights? Because the chief executive was absolutely determined that we were more interactive this year. Can we have some lights in the room, please?
And lots of roving
And
mice.
No, Mr. President, I'm afraid your click didn't work. While we wait for some lights in the room, oh, there we are. Anybody like to ask a question of our panel? Yes, sir. I'll come down. Where's the? You stay there. You all stay there. Don't get difficult. Where's the microphone? Oh, no.
Thanks, Richard. I just want to go back to the point about the saturation that you were speaking to.
They didn't think it was.
Yeah, no, but I mean, I just wanted to just, or maybe get back to you about it, because I think you would have noticed and you would have heard from certainly the keynote address from the morning, and what Lisiba is saying is that if you take Sandton and you try and compare Sandton to as close as Alexander, which is literally 5 minutes away from it, you almost have two different worlds. And the one world is so undersupplied that people will leave from the one area to come into Sandton, whereas if they had their own, where the retail growth could come from, is having retail nodes within the township itself.
Sounds like you're making a speech.
No, I'm just making a comment.
Next person, who'd like to ask our panel a question? Do we have a question from the audience? You're very quiet, lot. Either that or you're waiting for lunch. A question for you, Estienne. How worrying is the perception issue for South Africa and the property market at the moment? The things we've heard with the corruption, the administrative charge, all these things. How worrying is that for you?
Are you asking that in the context of a foreign investor coming to invest in South Africa? Look, I mean, obviously, when a foreign investor makes an investment decision, he has to look, one, at the fundamentals of the company and the property fundamentals and the environment it's in. But secondly, a guy coming from outside, and Paddy would be the best person to answer this, he has to look at the currency. Now, I mean, if you're only getting bad news out of a shop, then, you know, the currency is going to take a beating.
Are you invested in South Africa, Paddy?
Not at the moment.
Sorry? Speak up.
No.
No. Now
Not at the moment. Have been.
You have been?
Yes.
But you're not now?
No.
Why not?
I was tempted to say, as a suggestion of one of my colleagues here, that it's not in my mandate.
It's the wallpaper thing you were talking about earlier. You know?
Yes. All right. Okay.
That
well,
would be chicken, because it is in my mandate. You know, I have an index, but I don't have to put all the money in the index. I think it's to do with relatively low growth and relatively high political and economic risk.
Richard,
hang on.
No, I just want to...
We've just found an elephant in the living room.
To be honest, as a local investor, I don't want international investors in the market.
Well, who cares what you want?
No, and let me just explain why. If you look
Hang on. No, we'll come to you in a second.
All right, okay.
Let's not deflect ourselves from his political and economic risk.
And there was one other that I think he's going to refer to, which is liquidity. You know, there are only two stocks that have anything like the liquidity that we need to make a meaningful difference to our portfolio. You know, we've got a global fund of $1.5 billion US. In order to make any difference, we need to put 2% of that fund into a South African stock, and we would have to own half the stock, half the free float in almost all the companies. Growthpoint and Redefine.
So you'd end up with his problem?
Yeah.
Lisiba's problem. You wouldn't be able to move around easily. You'd have a liquidity problem, and you would effectively become the market.
Yes. Well, we would become the determinant of that stock's share price.
Right. So yes, I meant the market in that share price.
Yeah.
So you've stayed away.
Yes.
Now let's go back to the political instability question. What are you worried about?
I'm not the person to ask about South African politics. I'm going to duck that one.
Right. Why don't you want him here in the first place?
Well, if one looks at the past few years, in all practical reasons, we were a REIT market, but the structures that we had were very similar to REITs and were tax transparent for local investors. And secondly, if you look at our retail market as well as our mining market, the international investors coming into our, or not markets, sectors on the JSE, the international investors coming into those sectors are the ones causing a lot of volatility because they move money in and out when
Pesky foreign investors.
Very true.
Here
very
today,
true.
gone tomorrow.
That's so true. So that kind of volatility, I think the sector can't handle that kind of volatility, coming back to the liquidity of the sector, and it will just cause mayhem for the sector.
Andrew.
Liquidity is a work in progress. Consolidation will come. There's been a lot of new listings. There's a lot of counters that are in the sector. At the point when they don't all get access to capital, that will drive consolidation, and consolidation will drive liquidity. So this sector has grown enormously. If you wind the clock back to 2000, total aggregate market cap 5 billion rand. Today it must be 230, 240,
222.
Okay, so I mean, the growth in the sector, the number of counters,
But
the emergence of these world investment grade quality stocks like Growthpoint and Redefine, and there's lots coming. It's a vibrant, dynamic sector with a lot of change. That is the constant.
It's a vibrant, dynamic sector with lots of change. Let's strike out the word change and put risk in instead.
Risk.
I don't agree with that. And
Sorry?
I don't agree with that. If you, other than interest rates, which is a world phenomenon, and I think that is a global risk. So whether you are invested in Unibail or whether you invested in Growthpoint, interest rates remain a risk for a real estate investor or equity investor for that matter.
Let's take interest rates out of that.
If you go and then analyze the actual stocks which are listed on the JSE, if you'd like, vis-a-vis maybe some of the stuff on the ASX, most of our property companies are actually got property on balance sheet. You know, if you go and look at the AXX, you might find these guys are fund managers and mezz financiers and developers, and the property on balance sheet isn't actually all that much. So the companies we have on the listings are generally rent collectors in South Africa, and a investor can get a very good feel of what they're actually getting exposure to and what risks they are.
What was your phrase? Vibrant and something and change, full of change, and I've substituted risk for that.
Yeah.
What to you then, as we come to the end, because it's nearly time for luncheon, what for you is the one biggest worry, risk, concern in the next 12 months that we can throw back in your face next year?
It would be a combination of a dramatically weakening rand and weakening in our bonds. I think those are linked, and that factor could cause a dislocation in our listed property sector.
That could cause a financing question. The one, yes, you see, the one risk and worry on your agenda that we can use against you next year.
Well, I suppose from our side, because we're so heavily invested in the sector, and the sector is illiquid to a large extent.
Yeah.
I'm saying it's illiquid within a 12-month period. If we were to make a correction, we wouldn't be able to do that within a 12-month period. So if there's a downturn of great significance, then we're pretty much sort of stuck. You know, so from a concern point of view, one would say that if that were to happen, then we would find ourselves not being able to correct as quick as we would like to. But at the same time, that is better than if you are in unlisted properties, because there you really cannot move.
But that's, with respect, sir, that's just a restatement of the position, albeit very elegantly put. What's your biggest risk? Because he says there's not going to be a major correction, so that's not a risk. So what's your biggest risk? What are you most worried about?
In all honesty, we are more excited than being
You
worried.
don't seem it. You will forgive me.
No, if we mentioned that you have counters, you have new funds that are coming into the market.
Right.
So we sort of see this opportunity where we can invest more of our funds and there's more growth. If you compare that to the counters that are trading at extreme premiums. So we are not as...
It's a bit frothy.
Yeah, that's your frothy market for you. Right.
So apart from talking about the bonds, if there are issues with the bonds, etc., if one looks at what Estienne mentioned with the property companies that we have in the listed sector and the quality of the assets that are in there and the quality of management, then we believe that since at the end of the day, the investment is about the underlying assets, and the economics of those assets and the management of those assets are important, we're fairly confident.
Your 12-month risk.
I agree with Andrew in terms of its bond yields. And if you look at how many sectors that we've had, or listings that we've had in the sector over the last 12 to 18 months, that we're at the top end of the cycle, similar to a small cap or a financial or tech boom that we had in the past.
Oh, hang on. Hang on. Just say that again.
Looking at the number of listings that we've had over the past 12 to 18 months, we could be at the similar type of situation that we had with the small cap financials and tech boom in the late 90s, early 2000s.
Sorry, lunch will have to wait. Just remind us what happened with that small cap and tech boom in the 1990s.
Well, you had big corrections in the markets, price inflation, and then
the collapse.
Stock price inflation, and then a collapse.
The collapse.
Yeah. The thing is, I don't think we'll have a collapse because you've got an underpin in rental income.
Right.
So that makes a difference, but you'll have a correction in the market.
Right. Keep an eye. Hold on to your wallet. You, sir. He's talking about potential correction in the market. He's not worried. He's got bond yields on his mind. Yeah. Patrick, before I come to you last, what's on your mind for the next 12 months?
I'm worried about France.
That's great.
Aren't we all? By the way, for those of you who don't know, France entered a triple dip recession today with its latest GDP numbers.
Look, obviously, we manage a company, all right? So we have to worry about the things in our locus of control. Bond yields are things that investors that invest into our stock have to worry about, okay? And obviously, I'm a shareholder, so that is it will impact the value of my investment. But looking at it as a manager of a company, we will look at the things that drive the fundamentals in the actual business. So how we incentivize our people to perform better than the rest of the market, how we can ensure that our properties are more marketable, that they're full, and that our tenants pay us friendly, more rental than anybody else. And I think
listen to the chair. They like that.
I'm sure. And clearly, and that's where SAPOA comes in, is trying to mitigate some of the risks or work through some of the risks, these headwinds that are coming.
Hang on, that's your presidential speech. We'll
Sure.
wait till that, please.
But I mean, there's a link to that. So
well, I'm sure, but let's not...
making sure that there are platforms that these things can start to be addressed. Similar to how we dealt with the REITs. So you knew there was a tax problem. You had to climb in and do it, and fix the problem. So that is the strategy. For me to worry about bond yields, I can't go and worry about that. I have to worry about the fundamentals.
Have you heard anything, Patrick, that's going to make you open your wallet? Ladies and gentlemen, our panel, thank you.
Thanks, Richard.
Thank you very much. Excellent. Now, I think I have some other thing. Oh, yes, here we go. Bear with me, ladies and gentlemen. Now, as we head... Oh. They forgot the gifts. Does this come under the Bribery Act or the Foreign Corrupt Practices Act? Take pictures, they'll be used in evidence. Well, they're getting their freebies. Notice no freebie for me. Okay, I have to remind you that we have a mayor's panel tomorrow with the mayor of Cape Town and the mayor of Johannesburg. That will be fascinating, particularly since they don't agree with each other. No, they're not going to debate. Wouldn't that have been fun? We'll have one first, then the other, then I'll put some questions. If you have a secret question, God, I can't believe I'm about to do this. If you have a secret question that you would like me to put to one of the mayors, you can email it to me at richard@richardquest.com. And I guarantee you, I will not say where I got it from. Failing which, this afternoon we have Tony Leon, the former South African ambassador. We have a whole potpourri of events. We're going to have lunch, or you're going to have lunch. Remember, back here, 2 o'clock, I'll be taking lists, I'll be asking questions. Please don't waste time. Go!